Good morning, John. How are you today? You good?
Very well, mate. Very well. How are you?
Very good indeed. Here we go again. Another Friday, another webinar, another exciting webinar with you guys. It's always very insightful. We always get a lot of people attend the webinars as well, which is very, very good. Um, how's your week been?
Really busy. Yeah, been
Good.
down at the office this week. So we had a catch-up meeting with the team this week, so that was really good to see everybody. But they're just really busy, as you can imagine. At the minute, it's the hottest of hot topics. So lots of
Yeah.
new business inquiries coming in, and lots of good business, thankfully, off the back of that. So yeah, it's
Good,
all
good.
all good.
For the purpose of today, because I know you've got tons of content, I'm sure we're going to have plenty of questions throughout, as we always do. So we'll kick things off pretty lively today. Um, I need to just find where all of my buttons are because for some reason they have all disappeared on me, which is amazing. Um, can you see my screen okay? Is it
Yeah.
loading through? You've got it. Smashing. First things first, everybody, good morning. Welcome to Club Live. I hope you've all had an amazing week. I know some of you have said hi in the comments, which is great. We know things are working how they should be. As always, as I've just mentioned, if you've got any questions at any point throughout today's session, just let us know in the comments. There is a Q&A function as well, so if you'd rather ask things more privately, you can do so. I'll stop John in his tracks and we'll have a conversation around the question that's been asked, and we'll do our best to answer as many as we can as we go along. Um, if you require CPD, if you require a CPD certificate from today's session, when you exit the webinar, a feedback form will pop up. Please give us your feedback on today's session. As you complete your feedback form, there will be a section that will ask you, do you need CPD? And we will get that over to you. If it's not today, it will be first thing on Monday morning. So, as always, feedback is so important to us. It's how we improve, it's how we deliver better content. So, please do share your thoughts with us when you leave today's webinar. As always, the famous clicker never seems to work. And now I've jumped forward too many pages. Behind the club, it's Amanda, Lewis, myself, and the incredible Jade Ling, who makes most of this stuff happen for us. We do have an enormous backing now of so many incredible firms that continue to support us in what we're looking to achieve, but also supporting our members, our club members, our community members. We couldn't do what we do without the collaboration of some of these incredible firms. So a massive shout out. This does continue to grow every single week now, which is amazing. So a big thank you to everybody that is collaborating with the club. Touching briefly, I know some of you have come from our communities to just really want to touch on what we're looking to do and what we're doing at the moment. People absolutely need to talk. People do like to get some support as well. So we do have individual WhatsApp communities depending on the role that you play within your organization. If you're a business owner, a financial planner, a power planner, if you're dealing with all of the ops within your organization, we have separate groups for each and every single one of you. The WhatsApp groups are now sitting at around 1,400 people. I always recommend you mute them when you join our WhatsApp communities. Mute them because they do tend to go off throughout the day and you don't want to be interrupted. It's there to provide a level of support, not a level of distraction. So please do mute them when you join. We are going to be setting up a compliance WhatsApp group. We are being asked for it quite often. So we will be setting that up. I was asked to set it up this week. I've let the ball slip on that. It's my fault. It will be set up next week. As always, our club lives, our webinars, rebranded club lives, they are expert led, they're practical, they're CPD accredited, and it's just about giving back to the industry. Our podcast is where you can hear stories from those who are running financial planning firms today. So, where they began, fast forward to where they are today, the highs, the lows, and the ups and downs of everything in between of running a business. You know, it's not easy. People do need support, and that's what our community and our club membership is there to provide, really. if we have a quick little overview of the webinars that we've got coming up on the 27th of March, we are with Saturn. We're going to explore how AI is actually being used in financial planning businesses and what's genuinely scalable. On the 16th of April, really due to feedback from our communities and what people are asking for, Aspen are going to be running a session on investing for shorter time horizons and managing risk when time matters. And on the 6th of May, we are with Timeline as we look at how technology supports consistent portfolio performance at scale. So we've got some really good sessions lined up. I do believe there's a couple more that we're going to be sort of slotting in. One in April doesn't seem right to me. These guys normally have me behind the camera every Friday. So one in April doesn't sit right with me just now. So I do expect more to be coming in. What are we up to next? Look, John, I'm really pleased to have you with us again. The way you present, the way you deliver your content, and the value that you add to the wider profession is outstanding. You've got 35 years experience in financial services, specializing in helping advisors really mitigate IHT and protect family wealth across generations. Something that you're going to have to think a little bit more about yourself these days, John, as we've just had the conversation about using flexible trust structures. So, John, thank you so much for joining us today. Just as always, a little bit of a snapshot as to who's in the room with us today. IFAs, planners, and power planners in the room as well. The biggest challenge is determine suitability is the biggest challenge, followed by settlement order, which is something that you probably see all too often. It's when to settle the trust in what order. So I think you're going to give us some good insights into that today as well. There's clearly a demand for practical guidance on how to structure those trusts. When you speak to advisors, where do you typically find their knowledge, John? Are they quite knowledgeable around this whole trust planning, or are they quite green? Would you say?
Real mix, to be honest.
Is it? Yeah.
We see a mix of abilities. Depends on their experience. If they're experienced planners and experienced in IHT planning, they're normally got pretty good technical knowledge. The settlement order of trust is and things like 14-year rule, which we'll touch on today, are things that are sometimes misunderstood. But then equally you get, some planners who've not done much in the way of IHT planning in the past, but because of the changes, which again we'll touch on in a minute, that are coming down the line following the last couple of budgets, with more and more people coming into the IHT trap, they are now finding themselves, advising clients who've got IHT liabilities, and they're suddenly saying, we need some help, we need some support, we need some training, so we do a lot of master classes for advisors. We're going in and giving really detailed, presentations for an hour and a half on trust planning, and some of the stuff we've got in the content today is within those master classes as well.
Amazing.
Just to upskill them, so that they are feeling more confident to be able to talk to those people.
Yeah, I can imagine, many advisors would come to you with what they think is the right idea, the right solution. But it's how they do it in the correct order in which they do it as well that might be a bit enlightening for them, right?
Absolutely, yeah. We do encourage advisors to come to us to talk to us about specific cases, and that's really where the things that we present today get reinforced, because they're actually seeing it in practical terms with one of their own clients. So we are sitting down with them and looking at what the clients wish to do, in terms of what their aims and objectives are with regards to the planning, what assets they've got, what liabilities they've got, what gifts they've made previously, and then structuring things in the optimum order is very much what we do. So we very much like to get involved in those nitty-gritty of cases. As I say, it really does reinforce the learning and the things that they'll see today when we start to look at a specific case.
Good stuff. Good stuff. Well, over to you, sir. The floor is yours.
Thank you very much.
I believe you've got full permissions, if I've set it up correctly.
Yeah. Let me know when you can see that, and that comes up at your end, and you can see it all okay.
We can see it absolutely fine. Somebody's asked about us sending details about one of your masterclass sessions, and we can absolutely do so, right? We've
delighted to you.
Yep, got some dates that you can fire out and get some details over to whoever is interested. That'd be good.
Yes, yeah, with pleasure. So masterclasses we can either do like we're doing today as a webinar or in person, whichever, suits the firm best. But yeah, we're absolutely delighted to, to present a masterclass to anybody that's interested in them. So without further ado, if we jump straight into this,
Let's do
we're
it.
gonna look at multiple trust strategies for effective IHT mitigation. So let's look at the agenda and learning objectives. We look at consumer duty and foreseeable harm and how that impacts on all of the things that planners are doing today. We'll look at a case study and it'll be a before and after trust planning and see what we can do to help this particular couple mitigate their IHT liabilities. Look at how those multiple trust settlements can help the advisor to stay compliant with consumer duty, particularly looking at the foreseeable harm aspect of those rules, and the optimum order of trust settlements to mitigate entry, periodic, and exit tax charges.
Mm.
And following that with the 14-year rule and how to avoid it, because people will be tripped up by this inadvertently by doing what they think are relatively inconsequential things, but suddenly will form part of their estate and sorry, not part of their estate, part of the gifting pattern, and therefore we need to make sure we can avoid such things.
Exactly. John, I think I've got the presenter view. If
Have
you
you?
could,
Right, okay, yeah.
if you
Sorry.
can display settings and just swap that around, that will
Uh,
be.
Swap presenter views. Is that better?
There we go. I've
Is
got your
that
full slide now.
There you go. Right. Sorry about that. My apologies.
Is
Um,
just give us a shout if that's not sitting correctly for everybody. Yeah, Nathan's called out. We can see the presenter view.
yeah,
Yeah, we will provide the slides afterwards as well. Absolutely fine, not a problem. You always get a big demand on your webinars for sharing of slides afterwards.
good stuff. Good stuff. So that's okay now. Yeah, everybody can see that correctly. Can this all come up correctly?
Yep, I can see
Brilliant.
that
Okay.
correctly from my side. Yep.
Wonderful. So we've probably all seen these stats before, but we'll give a very quick run through. £5.5 trillion is set to pass between the generations in the next 30 years, which is just an eye-watering sum of money,
Mm.
and it's absolutely enormous. And we're starting to see that progressing now as we're starting to see things like the IHT receipts last year were at 8.25 billion. And I've literally seen something this morning which says that up to the end of, or up to February this year, it's 7.7 billion pounds already this year and is on target to hit the projection of 8.7 billion for this current tax year, which is no great surprise. And of course, because of the changes that we're seeing to business relief, agricultural property relief from the 6th of April this year, and also to pensions from next year, we know that those IHT receipts are going to continue to
Of
climb.
course they are.
Average IHT bills are increasing by 11.5%. They're set to rise. The IHT receipts are set to rise to 15 billion in the next 10 years. So a massive, massive surge in IHT. No surprise because we've got an aging population, so as a result of that, we're going to have 25% of the population aged 65 plus by 2050. So more and more people will be hoarding wealth, unless they start to do the planning, of course, up to that age. So, we start to need to look at what we're going to do beyond that. But that's, again, feeds into that £5.5 trillion that's set to pass through the generations in the next 30 years.
Mm.
And one of the key concerns we often find as people are getting older and we're starting to talk to them about IHT planning is care. It's the thing that's really deep-seated in the mind of people. And it often comes out when I meet a client with an advisor when we still start to talk about their IHT liabilities. And their key concern is running out of money.
Mm.
And the concern beyond just that in a simplest form is the cost of care. And saying, well, if I require care, I want to have the best possible standard of care that my wealth would afford me. What I find is people are not trying to avoid paying for care. People with wealth are trying to make sure they've got enough to be able to pay for the best possible standard of care, to give them the best possible care in their dotage. They're not looking to avoid it. So that's a key concern, and it's something that we obviously need to address as well. So from a consumer duty perspective, the consumer duty rules include foreseeable harm. So it's not just now about was the advice appropriate on the day it was made. It's also advisors are now having to look forward to say, well, what are the foreseeable harm issues in relation to this advice, and could we have foreseen, certain circumstances that could have occurred? So foreseeable harm includes detrimental tax implications and access to money. So again, if we just give money away, either directly to individuals or through a trust that hasn't got any reversionary interest, so can't bring money back to the settler if they ever needed it, that could be a detrimental issue with regards to a foreseeable harm perspective.
Mm.
And also things like leaving money in estates. So we can't just ignore other assets that are going to cause an IHT liability, for example. So things like ISAs, general investment accounts, cash held on deposit, etc. We can't ignore that in the round when we're talking about inheritance tax planning. We can't just go, well, we've done some inheritance tax planning with some element of it, and we've ignored all these other things over here, which are actually going to add to the problem. So that's also got to be considered to make sure that advisors are at least putting those forward to the client. And if the client says, well, actually, I hear what you're saying, but I only want to do those elements, well, that then is their decision.
Yeah.
But from a foreseeable harm perspective, the advisors giving them the optimized version of the IHT plan. And if the client then selects elements of it, well, that, as I say, is their decision. And access to money could, of course, be critical in later life to pay for care. So we don't want people to give away huge sums of money without having any access to it, and then leaving themselves short in later life, and they need to pay for care and they haven't got the money to pay for it. So it's crucial that we get those. We consider all of those aspects. So to remain compliant and deliver good outcomes, an advisor's file should clearly show that alternative IHT planning options were considered and discounted, and why they were discounted. Assess the impact of ISA growth on the future estate with mitigation options explored. So we can't just continue to let that grow unchecked in the estate. And include a justification for any IHT recommendation in the context of the client's wider financial position. So we've got to consider everything in the round to make sure that that client's needs for their own expected lifetime are catered for, as well as mitigating the IHT and making sure that we're not leaving assets sat inside the estate which are going to continue to add to the problem and create IHT issues. And an advisor can demonstrate they've considered foreseeable harm, not just the immediate planning benefits. So they're looking forward to say, well, if we do this, what's the impact on the foreseeable harm? Have you still got access to money? Are we going to get detrimental tax consequences if we're doing certain things or not doing certain things by, for example, leaving money in ISAs? Or continue to invest in ISAs, because some people have this almost ritual that they feel they've got to put, they max out their ISA allowance every year. But if someone's got an enormous IHT problem, actually putting another 20 grand in ISAs every year could actually be creating a foreseeable harm issue, because you're putting more money into ISAs which is sat inside the estate and growing in the estate. So deed of variation is something that we often look at, when we're talking to advisors about a particular case and we find out they've inherited money. My first question, and Mark, my colleague's first question, will always be, well, when did the person pass away that they've inherited the money from? Was it in the last 2 years? And if it was, well, we could do a deed of variation and take that money out of that individual's estate immediately. And that's something that, absolutely should be explored. So if they've got an IHT liability already, we don't want to push even more money into the estate from an inheritance, because that's only going to worsen their IHT problem. So can we get this money out? If you don't discuss a deed of variation, that could be a foreseeable harm issue, because that's an admission. You've admitted to talk about that. So it's absolutely crucial that it's considered, and we ask that question. When did that individual pass away, and could we then potentially do a deed of variation? As my colleague Mark always says, if it's not on file, it didn't happen. So it's absolutely crucial to get that down on paper, and it is logged, whether that inheritance that individual's received was from somebody who passed away within the last 2 years or over 2 years ago. If it's over 2 years, you can't do a deed of variation, so that's out of the equation. But if it's within the last 2 years, it definitely needs to be explored.
Interesting. Before we move on, we're going to just quickly ask the audience for some participation. Really, get their views and thoughts. What is your current level of experience when using multiple trusts for IHT planning? Where do you see some of the biggest knowledge gaps in the profession, John?
It's around things like the use of multiple trusts, 14-year rule, inheritance tax taper relief. That's massively misunderstood, and we did a short bite-sized webinar on that a couple of weeks ago, which is available on our YouTube channel, because that's hugely misunderstood. People think that you are tapering the gift, and you're not. You're tapering the tax rate. So, for example, you don't get any IHT taper relief until the gift exceeds a nil rate band of 325, because the first 325 is taxed at nil. So it's only when you get beyond that you start to get taper relief. But I've heard it from clients, I've heard it from advisors saying, well, they've made this gift of £100,000, but taper relief will start to apply from the third anniversary. And I say, unfortunately, it won't, because they're still within the nil rate band, so the tax rate on that 100,000 is nil. So you're not getting any IHT taper relief on that until such point as you get beyond the 325. So it's stuff like that you find where the little bits of knowledge gaps are.
Yeah.
That we can, help to fill that in and give them the knowledge and make them feel more comfortable with it.
Do client expectations also influence the way trusts are being used?
They do, absolutely, yeah, because the clients are looking for, obviously, the panacea of being able to, well, I can get this money out of my estate, still access it if I need it, and if the beneficiaries need financial assistance, we can get the money to them. That is the absolute panacea, and that, fortunately, is what we've got. People are often concerned about giving money to the kids directly, because what happens if my son or daughter gets divorced? Well, half of my hard-earned wealth disappearing out of the family in a divorce settlement, ultimately, if I give it them money. So people are reluctant to do it, just in case that situation occurs.
And how important is it, the collaboration of advisors with specialists in this particular area?
I think it's hugely important,
Yeah.
because we do see this knowledge gap. So again, I've seen a report, or an advisor sent me an excerpt from a report that had been compiled for him by an external paraplanner, and it was they got the IHT taper relief thing wrong this week. So I was able to say, no, your understanding is correct. That particular gift that won't be IHT taper relief won't be applicable because it's within the nil rate band. So there are little knowledge gaps out there, and we need to help fill those, really, and educate people so they get the technical content correct, because obviously that's going into a suitability report. It's absolutely paramount, and that is correct.
Yeah. The results are in. Do they surprise you when it comes to people using multiple trusts? The advanced,
No, that doesn't
selection there is
surprise
very
me, to be
limited. It
honest.
doesn't
Yeah, it is
surprise you.
limited. Yeah, no, it doesn't surprise me, because most advisors, we find when we're talking about a specific case where multiple trusts would be very useful and help them to mitigate their IHT liabilities in the optimized way. A lot of advisors haven't got the experience of settling multiple trusts, and particularly set them in the right order. And that is crucial. So I'm not surprised by those results, to be honest. I'm probably surprised that the advanced elements is so small, but not surprised by sort of non to beginner, that sort of threshold. That isn't unusual.
Yeah. Yep. Agreed. I will stop sharing and you can
Okay.
continue. Thank you very
Brilliant.
much.
Okay, you're welcome. Cheers.
I think that might still be on your screen now, Johnny.
Oh, it
I
is.
think,
Yeah, there you go.
yeah, I think you got it.
Oh,
For
is that
some
done?
reason, when
There
I
you go.
stop, it stays on yours.
Yeah, I was going to say, it's stuck on my screen for the moment. I wasn't sure it was just going to disappear magically, but it didn't.
I thought you were.
Yeah.
I could tell by the way you was looking. I
Yeah.
thought, you
Why
want
is that still there?
it's not disappearing. You got to do it
Yeah, yeah.
yourself.
Yeah, no problem. So deed of variation, as I say, it is something that really ought to be discussed. It is a legal framework that allows somebody to change the terms of an existing will or trust. It can be used to potentially alter the distribution of assets, add beneficiaries, or make changes to an estate, and that can really help to protect assets. And it can also be used to vary in intestacy, which again, most people don't know. Most people think you're going to do it if there's a will or a trust in place, but you can vary in intestacy. It's more complicated, but it can still be done. From a client benefit, it can obviously deliver protective and tax efficient frameworks, where they've experienced, a family member passing, typically, where the distribution of that estate will be inefficient from an IHT planning perspective. And sometimes it can just help us just to simply skip a generation. Just actually go, we don't want to leave it to the next generation because they've already got IHT liabilities. We might just skip straight to the next generation, to the grandchildren of the people who've passed away. Or it could even be varied into a trust to then be able to pass those assets out to the beneficiaries in a way in which they could, for example, receive money from the trust as a loan, and therefore it can be better protected. And we'll look at that in a minute as well. But it also shows that the advisor's got the knowledge to make sure that distribution of that estate is done in the optimised way and in the most tax efficient manner, and it demonstrates to the client that this is an advisor that really does know their stuff, with regards to IHT planning and how best to distribute estates. So it shouldn't be relied on. It isn't a substitute for good lifetime planning, but it is an option if somebody either has lost capacity and therefore can't change their will, or they've passed it and their will wasn't as efficient as it could have been. It is something that could be used to make that distribution more efficient than it would have been if we just left it via the will. So we're going to look at this case study today, and it's a very contrived case study, I have to admit, because it's to demonstrate a particular point. We'll see that this couple's estate tots up to 2.7 million. So very good size estate. But at 2.7 million, of course, you lose all of the residence nil rate band allowance. So the residence nil rate band starts to taper away once the estate exceeds 2 million. And it tapers away at £1 for every £2 you're over. So for a married couple, when they get to £2.7 million, they've lost all of the residence nil rate band, which means that their estate has got an £820,000 IHT liability. And in this particular case study, we haven't even factored in things like pension pots, which of course were going to fall into the estate with effect from the 6th of April 2027. But we can see in this situation, there's a sizable IHT liability. They've got very good income and they've got very good life expectancy. They've got 2 children and 2 grandchildren. Now, their ISA portfolio, they could, of course, just move that into an AIM ISA. Now, of course, the thing to remember is from next month, that's only going to get 50% IHT relief in all circumstances. And the thing with an ISA, you can't wrap it in a trust, you can't gift it away, and therefore that actually won't help in any way whatsoever with regards to the residence nil rate band, because the AIM ISA is still owned by the individual, and therefore it forms part of their estate. So what we're going to look at for this couple is a multiple trust strategy. And it's going to look like this. So we're going to look at a loan trust. So we put £350,000 each into a loan trust. They aren't gifts. They've got immediate call on that £700,000 in a loan trust. With a drop of a hat, if they wanted to call that back, they could just call it back the following day. We're going to look at gifts from income trust because they've got £30,000 a year each of surplus income that we're going to gift away, and that's immediately removed from their IHT assessable estate under the gifts from normal expenditure rules. And we're going to look at a flexible reversionary trust, gifted away £331,000 each, which is 325 a nil rate band, on their annual gift exemptions for the current tax year and the previous tax year, adding another 6, gives us £331,000 each. The thing with the residence nil rate band rules is the fact that the minute you gift money, it comes out of the residence nil rate band calculation. It's still in the IHT calculation, but immediately it comes out of the residence nil rate band calculation. Because what all that hinges on is who owns the asset. The minute you've gifted something, you don't own it. And therefore it comes out of the residence nil rate band calculation. So we can see for this particular couple, by settling a trust as stated there, we've got their residence nil rate band assessable estate back below £2 million immediately. So they've immediately reclaimed £168,800 worth of IHT saving. And that's made up of £350,000 of nil rate band each at 40%. That's 140,000. We've got £24,000 of IHT saving as a result of the gifts from normal expenditure, the 60,000. And then we've got £6,000 each of annual gift exemptions. So that's £12,000 multiplied by 40%, it's £4,800. So literally overnight, we've saved them £168,800 in IHT just by putting the planning in place using multiple trust settlements in those particular settlement orders. So if we then just dig into the detail of each of these trusts. So a loan trust, as I say, you're not getting the original loan out. So that red block is remaining inside the estate. So in that particular example for the couple, we've got £350,000 of original loan going into that. And that's still invested as per their risk profile. In conjunction with their advisor, they'll assess what their risk profile is and invest it in appropriate funds. The blue wedge is hopefully it's increasing in value over time. All that increase in value is free of IHT and outside of their IHT assessable estate because the growth is attaching to the trust and not them. Their original loan remains inside their estate, and therefore they've got immediate recall on that loan at any given moment. So they could recall it in piecemeal, or they could recall it as a lump sum. So that is never getting outside the estate, the original loan, but all of the growth is. So we're capping off the IHT liability on that particular element. And we use that as a holding vehicle for the second round of nil rate band planning. So when these clients have lived 7 years and their original gifts we're going to look at in a second have been removed from their estate, they could take, say the nil rate band still £325,000 in 7 years. Let's hope it's gone up, but let's say it stays the same. They could take £325,000 of the original £350,000 loan back and recycle the nil rate bands and use it again into another gift trust. And we'll look at the gift trust in a second. So this is a perfect holding vehicle. And again, from a foreseeable harm perspective, it's stopping that accumulation of value in the estate because the growth is outside the estate and attaching to the trust. And then we've got the gifts from income trust. This isn't about capital, it's all about surplus income. So the first thing we've got to identify is what can we use? Well, surplus income, the obvious one is salary, but beyond that, we've got buy-to-let property income, we've got pension income, we've got dividend income. The biggest area for us for this particular trust are those people who've got surplus pension income. Now, historically, that's been those people, and we're in the last generation of them, I hasten to add, who've got very good final salary pension schemes. But now we're seeing, of course, with the changes to the rules proposed with regards to pensions coming into the estate from the 6th of April 2027, people looking at their pension fund and saying, I can't leave that sat there now. And we are seeing lots of people who've got £1 million plus in a pension fund, which is going to obviously have a dramatic effect on their IHT liabilities when it drops into the estate. And it literally is a change overnight, isn't it? 5th of April 2027, it's not in the estate. Following morning, it's all in the estate, and that £1 million is just added into the estate in that example, and suddenly there's a massive IHT liability, and that can destroy things like the residence nil rate band by taking all that away because it all gets added into the residence nil rate band assessable estate. So there's a few simple rules to follow to get this immediate exemption. So you've gifted it, it's immediately outside the estate. It's got to be regular, or the intention is it's going to be a regular pattern of gifting. So again, the intention bit is absolutely paramount. And therefore, we would look to seek to clarify that that is going to be an intention that the client's going to do this over multiple tax years. It's got to be from surplus income. Doesn't necessarily have to be all net income in terms of it has to be taxable income. So, for example, if you have an ISA portfolio which generated a natural yield, you can use that yield, even though it's tax-free, to be able to gift it away. And things like people who are in UF Plus doing a drawdown from the pension fund of 25% PCLS, 75% taxable. HMRC don't differentiate between the non-taxable and the taxable elements. They could give away all of that income that they're drawing, even though 25% of it is PCLS and tax-free. And it mustn't impact on their standard of living. So HMRC produced a form called an IHT 403. We've extracted all of those exact fields into a spreadsheet that people, again, will gladly send that to people if they're interested in that. And you would list down all of your income sources per tax year and all of your expenditure. And therefore, you can then calculate what the surplus is and what you can gift away. The little known bit of this legislation is HMRC will allow you to go back 2 complete tax years. So at the moment, we could go back to 23, 24, 24, 25 and say this is accumulated but undistributed surplus income from those tax years. They could give that away as a lump sum and it's immediately exempt from their estate, provided it is their intention they're going to continue to make gifts from surplus income in future tax years. So we can mop up going back 2 tax years. Anything over those 2 tax years, you've lost it. That's now capitalised.
John, Patrick's asked, why do you need to put it into trust when you can use gifts out of normal income?
You could just gift it directly to people, but again, it's all about control and access. If I gift money to my children or grandchildren, I've lost control and access to that. It's their money, and they get used to having that money, of course, because it's coming in on a regular basis. It's very difficult for me to then turn around in 20 or 30 years' time and say, I've left myself a bit short. Can I have some money back, please? Because they've probably spent it. They haven't just sat it in a little box just in case I ask for it back one day. The other thing is I'm pushing it into their estate. So it's making, potentially creating an IHT problem for them. But also, if your children or grandchildren were to then get divorced and you've given them the money, well, half of it's going to disappear out of the family. Whereas if we're routing it through the trust, we can protect it. Right. So this particular trust, we've got the ability to pass this money out of the estate. It's all immediately exempt. But in this instance, we've wrapped the trust wrapper around it, easy for me to say. But we've then got a deferrable reversion back to the settler. So from the 5th anniversary, they can start to draw money back from this if they needed it. If they don't need it, they can just say to the advisor, I don't need it. Please ask the trustees to leave it in the trust. And that's what we would do as the trustees if they don't need it. We don't want to be pushing money back to people who don't need it, because that means we're just accumulating it back inside the estate. That is completely counterproductive. So if they don't need it, they just tell the advisor they don't need it, and the advisor tells us, and we defer it to the following anniversary. No tax consequences of doing that, because we as the trustees are making that deferment. We can also loan or appoint money to the beneficiaries at any time. Now, loans is underlined for a reason. If we loan money to a beneficiary, the loan remains an asset of the trust and a debt of the recipient, which means if that recipient beneficiary gets divorced, goes bankrupt, needs care themselves, or has got their own IHT liabilities, it's not their money. It's netting off against their estate and their asset value. Whereas if we appoint it, or as the question was, we just give it to them directly without using a trust, it's their asset. So if they get divorced, they go bankrupt, they need care, they've got their own IHT liabilities, it's their assets, their money, it's all attackable, and therefore could be disappearing out of the family. So we do a lot of loans, particularly on the mature book of business, and it's often generation skip. So actually, we're passing money to grandchildren to help them get on the property ladder, for example, help them put a deposit together for houses, or pay a chunk off the mortgage because the interest rate's gone up and they come to the end of a fixed rate deal. They want to extend the house or whatever it may be. There's a whole raft of reasons why we're loaning money to beneficiaries, but a lot of it is often linked to something relating to property, either buying it, extending it, buying a holiday home, a whole raft of reasons why we're loaning money to beneficiaries. And then the gift trust, we'd be looking at gifting capital up to the nil rate band, not exceeding that, so we don't hit that 20% entry tax charge when you get above 325,000. As I mentioned, for this particular case study, those clients haven't used their annual gift exemptions for the last 2 tax years, so we can add those in as well. So you've got 325 a nil rate band, £6,000 of annual gift exemptions, make a gift of 331 each, pass that over to the trustees. There's no entry tax charge on that because they haven't exceeded the nil rate band net of the annual gift exemptions. So we've got £331,000 gone into the trust. We would parcel it because we invest directly in collective. So our trust is CGT assessable trust, not income tax assessable trust. So we would invest that in collective investment funds as per the advisor's recommendation. But we would typically use a 10% per annum reversion pattern. Keeps the maths nice and simple for the client. So it's 10% of the value of the trust that could come back each year. So if we put £331,000 in, each one of those parcels contains £33,100 worth of capital in the first instance. And each year that money can come back if they need it. Now, invariably, we find that most of these people don't need it because we're not taking all of the money out of their estate. We're saying to them, right, we're going to keep a rainy day fund. Your rainy day fund is what you would access in the early years if you need money. And as and when you need money, you'd access the rainy day fund first. But once we get beyond the rainy day fund, if that's exhausted, well, then we would start to access the trust money if they need it. So they might say, well, I don't need 10%, but I wouldn't mind 2. Okay, well, we revert 2% and we'll defer the 8% to the following anniversary. So we've now got 18% in the following year. That year they might say, I don't need anything. We'll roll all the 18% back to the following year. And the year after that, like 3%, and we defer the 25. So on the left-hand side, you're only ever taking about what you need and what you're going to spend. And on the right-hand side, they're telling the advisor that they don't need it, and we'll defer it if they don't need it. So those parcels, you've got a snowballing amount of money that's potentially available on each anniversary, and that's purposeful to make sure that there's plenty of money available to people should they need it. But also, we can make loans or appointments, as we saw in the last slide, to the beneficiaries at any time from this trust. And again, the loans that we're making are typically something to do with house purchase or extension of a house or whatever it may be, paying a chunk off the mortgage because the interest rates are going up. Loans can be non-interest bearing with no repayment schedule. So it's just a sum of money that's owed back to the trust at some future point. Now that loan can literally remain outstanding for the rest of that recipient's lifetime. So when they pass, that loan is netting off against their estate, it's not adding to their estate. And therefore it's reducing their estate from a probate and IHT perspective. Once probate's been resolved and their estate can be wound up, we can pass the money back into the trust, and that money can then be loaned out to the next generation. We just keep passing money through generations as loans. All of these trusts we've looked at have got a 125-year perpetuity period. So could go through 5-6 generations of a family, just loaning money to successive generations to make sure we're not just pushing the IHT problem down the line, which is what typically happens if people don't have that facility to be able to loan money. The only way you can get it out of the trust is to appoint it, or you're giving money directly to the next generation. You're just pushing the IHT problem into somebody else's estate, ultimately. So what we've then got in this particular case, we've looked at those 3 trust solutions, and we've got these significant tax savings. So what we'll look at in a second is we'll look at the optimum order of those trust settlements and why we've got them in this order to make sure we maximise the efficiency for entry, periodic and exit tax charge purposes. But at this point, I think you're going to run the next poll, aren't you, mate?
I am indeed. What typically slows advisors down when looking at putting these multiple trusts in place?
It's often the reorganisation of the assets, because of course most of these people aren't sitting here with a load of money sat in cash, waiting for somebody to come along to say you could do some IHT planning. So it's normally the reorganisation of the assets is the biggest time barrier to getting these things done quickly. So it's often they've got money in ISAs, GIAs, cash accounts. Some of them have got tied up in a cash account, which is a fixed term account, and then the advisors then looking at, well, there's going to be a loss of interest to get the money out of there early. But again, we don't want to delay doing the IHT planning for a relative small amount of interest that they might be losing out on, if that's going to have a detrimental IHT liability. And we have genuinely got a case where a settler, and I know the advisor had been talking to this client for several years about IHT planning, where the settler died less than 24 hours before the 7-year intervivos clock would have expired on his trust. And I know the advisor had been talking to those clients for years beforehand about doing trust planning, and it delayed. And then unfortunately, he died with probably less than 12 hours actually of his intervivos period to tick. And that then meant that his £100,000 gift into that particular trust wasn't successful and fell back to his estate and used £100,000 of his nil rate band. So we don't want to delay things unnecessarily, for relatively small amounts of interest, for example, if you're in a fixed term account. So
how much of this comes down to knowledge versus confidence, would you say?
Oh, massive. Yeah, I mean, that's huge. Yeah, it's having the knowledge to settle the trust in the right order, and then the confidence of doing that and putting that proposal to the client, which is why Mark and I get very involved in individual cases to then help the advisor to put that structure in the right order to maximise the benefit and optimise the tax planning and make sure we get it in the right order. Because we're experienced in doing it. It's what we do day to day. It's second nature to us, but it isn't second nature to everybody because they're not used to dealing with it.
And how much support do you think advisors typically need when looking at this kind of strategy, would you say, for their clients?
A lot of support, I'd say. Maybe the 2% in the advanced, on the first poll, they might not need as much support, but the other 98%, a lot of support just to help them get it in the right order. We'll put together a summary of the ideas for a particular client and say, well, this is the reason we would put these trusts in place. This is the optimum order. These are the advantages and disadvantages of the trust planning that we propose. And
this is the thing, right? Clients don't know the best way to mitigate tax or to get their money working harder for them. That's why they go and sit in an advisor, right? And the advisors, it's a similar thing. If they don't know the best way to prioritise trusts and what trusts work well in what situation, then that's you just go up the line a little bit, don't you? Then you lean on specialists and come see people like yourself, right?
Yeah, absolutely. And the beauty of this type of planning is that a client can't do this online. A client could easily go online and do an ISA, for example. Well, they might not pick the right funds or whatever, but actually putting the structure in place, they could do it. So that type of thing is easy enough to do. And there's loads of obviously people out there that offer that type of service when the client can just go direct. They can't do it with this. I mean, this is far too complex in terms of its structure for an average client, whatever an average client is, but they'd have to be a trust specialist themselves, I think, to be able to put this in place for themselves without taking any advice. And they would probably be able to push to do it full stop, because they wouldn't be able to find the right people to do it for them. So it is the best area to be in, because people are absolutely needing advice to do this. They can't do this
Yeah.
on their own, and advisors are then looking to specialists like ourselves to say, help, what do we do here? We've got this massive IHT problem for this client. How can we best structure this to mitigate IHT in the optimum way? And that's what we do.
Yeah. And I think, and I'm just going to share the results to everybody. I think there's so many moving parts that it's quite interesting to see that the challenges, as you're seeing on the results, they're just varied, aren't
Yes.
they? There's, it's not everybody's sitting in one box. It's a bit of everything amongst the whole
Yeah.
spectrum.
Yeah, and the interesting one, I think, is the bottom one. 41%
Yeah,
saying all of the
or
above.
just all of
It's
that.
all of understanding all of
Just
that is
yeah,
the the difficulty when it comes to settling multiple trust, and what the knowledge and the most challenging aspects of that are. So yeah, that again doesn't surprise me. From experience that's where people are with it. Yeah, yeah.
It's just, yeah. Even in the chat, someone said, "Look, would you be able to share the recording? Because there's just so much to digest."
Oh, it is, yeah, and that's another reason why we did the masterclass, is because there
Yeah,
is a lot to
it's
digest,
so much.
and
Yeah,
we appreciate that. And yeah, absolutely, we can share the slides
yeah.
and the recording. Yeah,
The slides and recording will be shared to everybody as well. So yeah, that's really good. I will stop sharing for the audience, but don't forget, get rid of
yeah.
it from your screen.
There you go. Take it off there. So if we then look at trust settlements, we only settle single settler trusts, and the reason we do that is if you look on the left hand side in the grey box, we've got Mr. and Mrs. Smith as joint settlers. If Mr. Smith passes away, we haven't got any additional flexibility with Mr. Smith's trust now, because Mrs. Smith is surviving as a joint settler of that trust. But if we separate them out and each settle their own trust, as we've seen in that case study, Mr. Smith passes away, we can add Mrs. Smith to Mr. Smith's trust as an appointed class beneficiary. And what that means is we can now loan or appoint money to Mrs. Smith, so she's got access to the trust money that's in Mr. Smith's trust. And the analogies I always use there are my own parents. So if my dad had passed away before my mum would have seen a massive drop in pension income, because the predominant pension benefit was on my dad. So my mum would have seen a 50% drop in income overnight, still got all the household expenses, and suddenly, half the income. So that would have been a big problem. But if my mum could have then been wanting some dad's trust as an appointed class beneficiary, and we can loan money to mum from dad's trust, mum is spending that money and leaving the debt attaching to the estate, which is reducing her estate for IHT purposes. So we would always settle single settler trusts, because it gives us much more flexibility than having joint settler trusts. So let's look at the optimum order of trust settlements or gifts. So first of all, we start off with a loan trust, because you haven't gifted anything. You've only made a loan. So if we start with a blank sheet of paper, this is the optimum order of doing it. Loan trust first, no gift is made. You've just lent a sum of money to the trustees, which is still in your estate and you still own, because it's still got that loan element still going to come back to you at some future point. Then we would do gifts from normal expenditure, because it's immediately exempt. So that trust wouldn't accumulate with a loan trust, because that gift is immediately exempt and the first one was only a loan. Then you would do a chargeable lifetime transfer, no entry tax charge up to the no rate band and the annual gift exemptions, as we saw in the case study. That trust doesn't accumulate, should I say, with the first two trusts, because the first one was a loan trust, the second one was immediately exempt, and the third one was actually the gift trust, which uses some or all of the no rate band. And then you would do pets, and you want to do pets as close to the third option there, the chargeable lifetime transfer, as possible. A day between them is perfect, because what happens if you make a pet within the inter vivos period of a chargeable lifetime transfer, you extend the 7-year inter vivos period of the chargeable lifetime transfer from the date you made the pet. So in this example here, if you made the pet the day after a chargeable lifetime transfer, you've only extended the inter vivos period by a day. And therefore, that's not likely in most instances to cause a problem. What you don't want is a massive gap between of years, and therefore you could be then looking at an inter vivos period on a chargeable lifetime transfer of, say, 10 years if you did a pet 3 years after you did a chargeable lifetime transfer. So it's absolutely important to get the optimum order of the gifts. in the correct order and the settlements of the trust in the correct order. Sometimes we'll find a client's already made a pet. Okay, that doesn't mean they still can't put the nil rate band into a chargeable lifetime transfer, but we just need to be conscious of the fact that if that client then doesn't survive the inter vivos period of their earlier pet, and by definition it wouldn't survive the inter vivos period of the later chargeable lifetime transfer, the failed gift element all get added together and get added back into the estate. So you could end up with an exit tax charge on the chargeable lifetime transfer if the total exceeded the nil rate band of the failed pet and the failed chargeable lifetime transfer. But that's the sort of thing, again, we're experienced in. So we would talk advisors through that if we come across that in a particular case. But if we're starting with a blank sheet of paper, this is the order. Loan trust first, then gifts from normal expenditure, then a chargeable lifetime transfer, then a pet. If you settle those gifts and trusts on separate days, they are not related settlements. And therefore, they don't get accumulated as one big trust. Each one of them would have its own nil rate band at every 10-yearly periodic charge assessment. However, if we muddle the order up, so let's say we did number 3 first, and then did the loan trust and the gifts from normal expenditure trust, the only trust that would have a nil rate band at every 10-yearly periodic charge assessment would be the chargeable lifetime transfer, because that's the one that was a gift and was a chargeable gift, albeit it was chargeable at nil. So getting the order right is absolutely imperative to mitigating tax charges as they go on at a later date.
I think we've had a couple of questions coming in. I think we're answering these as we go along, actually. So
Sure.
Way offer a flexible reversionary trust, don't they?
We do, yeah.
Good. If somebody's utilised their nil rate band, what solution do you suggest?
So if they've used it already with a chargeable lifetime transfer, we don't want to do another one within the next 7 years of that, because if we do, that's then going to trigger an entry tax charge. So if they've got surplus income, we'd use the surplus income trust. If we've got if they got the ability to use a loan trust, so again that could be utilised, but again we haven't got the optimum order we haven't got the order of the trust settlements in the optimum order. But if the plan would be we're only going to use the loan trust as a holding vehicle for the second round of planning, because they've already done a chargeable lifetime transfer in 7 years' time, if we're going to take the loan element back and then gift that into a new chargeable lifetime transfer after the first one has passed through its inter vivos period, when we get to a periodic charge assessment, if any money's left in that loan trust, it's only ever going to be the growth that's assessed anyway, because any loan is still due back to the settler. The other option would be just to wind that loan trust up and pass out all the growth to the beneficiaries, so you then only got 2 trusts instead of 2 trusts and some residue left in the loan trust. So that's an option. Again, if they were some way through the chargeable lifetime transfer and they got very good life expectancy, I'd still be looking at the loan trust and the gifts from normal expenditure trust personally. But some people might say, well, we could wait for 12 months because this gift's about to fall out and then we can do the planning then. We just don't want to keep money inside the estate because it's becoming a foreseeable harm issue if we haven't actually addressed that problem, and it could cause a tax consequence if we're not careful. So things can still be done, but we would look at that in the round on a particular case to say what's already been done, what gifts have been made already, and what can we put in place, and what are the advantages and disadvantages of doing that, and what's the risk in inverted commas of doing that planning now, because we might get an exit tax charge issue. But yeah, we definitely look at that, on a case-by-case basis. Obviously, there are things like business relief solutions, if that suits the client's risk profile, that don't interact with what we do, and vice versa, which could be something that could be considered. Direct pets could be considered, but again, if you've made a chargeable lifetime transfer, we just need to be mindful of, what we're about to move on to is this 14-year rule, where you make a pet within the inter vivos period of a chargeable lifetime transfer, and people are going to get tripped up by this as by making a simple gift of relatively small amount of money. If you gave away £5,000, for example, you could then suddenly be into a point where you've made a potentially exempt transfer because you're above your annual gift exemption of 3,000. And it's not a lot of money in the grand scheme of things. If somebody's got millions of pounds in an estate, but suddenly they could find themselves getting tripped up by this 14-year rule. So this
Um,
occurs. Go on, sorry.
just real quick, I've got a couple of questions come in from Joshua
Yeah.
and Kate. I'm going to absolutely ask those questions to you, but I just want you to get through your slides because I know we're
Okay.
5 minutes out, and I know we're a couple of slides away.
All right, no problem. So yeah, I'll whiz through this. But yeah, you give obviously the detail. So the 14-year rule kicks in when a pet is made within the inter vivos period of a chargeable lifetime transfer. And it extends the inter vivos period of the chargeable lifetime transfer from the date of the pet. So if we take an example, a settler makes a chargeable lifetime transfer gift on the 1st of May last year. So the inter vivos period extends until midnight on the 1st of May 2032. But let's say on the 30th of April 2032, so the day before their chargeable lifetime transfer was about to drop outside the estate, they make a gift, they make a pet. That means the inter vivos period of the pet extends to the 30th of April
Mm.
2039. Now, if that person dies before midnight on 30th of April 2039, the chargeable lifetime transfer is still an account, because what you do is you go back to the original pet date, which in this example would have been 30th of April 2032, to say, did this client make any gifts via a discretionary trust in the preceding 7 years? And in this case, they would. Now, this is the absolute worst case scenario, which is why you get to 14 years, because this client, 6 years, 364 days after they made the chargeable lifetime transfer, they made a pet, and then they died within that inter vivos period. And suddenly we've dragged back the chargeable lifetime transfer. And I say people are going to get tripped up by this with inconsequential amounts of money. They could give away £5,000, £2,000 above their annual gift exemptions. They've made a pet. And suddenly they could find themselves, in this scenario. So planning is absolutely key. And we would always suggest that your advisor puts in bold type in the report, do not make any gifts above your annual gift exemptions or what you can support from surplus income without talking to me first. And then if the advisor's unsure, they can come and check with people like us, to check what the client's planning to do. And if they're planning to get money to their children, we can actually say, if we've got the trusts in place like we've looked at today, well, why don't we just get the money from the trust and either loan it or appoint it to them? And again, preferably we'll loan it to them so we can protect that asset rather than you making another gift. Let's get this gift outside of your estate that you've made and the planning that we've made in the first instance, and then when you get your nil rate band back after 7 years, we'll recycle it and we'll do it again. But let's not throw a spanner in the works by just making a gift and just changing the whole dynamic of things.
Mm.
I say people are going to get tripped up by this for inconsequential amounts of money, and I've seen it. I've genuinely seen it where somebody did one of our trusts, one of our gift trusts, 3 years into it, review with the advisor. She says, "Oh, by the way, I gave my Barclays shares to my boys, the three sons." And I said, "Well, it was a matter of interest. How much were the Barclays shares?" "Well, oh, not a lot, like 60 grand." Well, of course, she's now with a pet.
Mm.
So she's actually extended the inter vivos period of a gift trust from 7 years to 10 years because we were 3 years into it. Thankfully, she's gone through that now. But of course, we then reiterated, don't make any gifts, and without checking with us first. Because had she checked, we'd have said to her, well, pass those shares to your husband. That's an interspousal transfer. There's no IHT, there's no CGT implications of that. He could have then gifted the shares to the three boys and it wouldn't have upset what we put in place, but she'd already done it, so we couldn't unwind it. But stuff like that, we just look and go, well, there's another route of doing this. Let's do it that route instead. So key to this is, talk to the advisor if they're thinking about making any gifts above annual gift exemptions or what they can support from surplus income.
Just want to do a quick call out and
Yeah,
thank
sure.
Mark from Way Trustees for answering some of the questions in the chat. So I can appreciate that, we're coming close to 11. People might need to dart off. So
Yeah,
Mark's
sure.
in the chat, also answering some of your questions as well. So thanks, Mark.
Yeah, brilliant. Cheers, Mark. So the loan facility, this really is the key to the intergenerational wealth transfer. This is the only way you can protect that money intergenerationally. If the only way you can get money to people is either to give it them directly as an appointment from a trust or you just give it to them, you can't protect that money because it is going to be part of that individual's assets and estate. But if we keep loaning money to successive generations, that loan is a debt on the recipient and an asset of the trust.
Mm.
And say this trust could have 125-year, or these trusts we've looked at today could have a 125-year perpetuity period. So we could be going through multiple generations of the same family, just continually loaning them money. We always encourage people to give us a letter of wishes that tells us what they would like us to do with their money in their trust fund and how they would like us to distribute it. And it's absolutely best practice to at least consider loaning the money in the first instance. So as a quick example, if we had £1 million and we're passing it through each generation, and we've only got, in this example, only using one nil rate band, each time it passes through a generation, we can see that that money is reducing because each generation is getting charged IHT on it because it's inflating the next generation's estate. So over those 4 generations, that money's halved in value. But if we've got £1 million in a trust that we just keep loaning to successive generations, it's still worth £1 million at the end of it because there's £1 million of loan still outstanding. It isn't getting hit for IHT every time it's going through each generation because each generation owes that money back to the trust. So it makes much more sense to loan it than appoint it. And then we're looking at all of these, social impacts. Divorce is the big one. People are really worried about giving money directly to the kids because if they do that and the kids get divorced, well, half of it's disappearing out of the family. Bankruptcy, hopefully we don't see that too often, but of course we know it occurs, and that could be 100% of the assets that are lost if you've just given it to them. But again, if we have lent the money to that individual, we can protect it from bankruptcy because the money is owed back to the trust. Care fee assessment of the beneficiary, again, if we just give them money and they require care in later life, it's in their estate. But if we're loaning money to them, well, that's not their asset, they still owe it back to the trust, so it makes big sense to loan it to them. And sideways disinheritance, unfortunately, we do see this, and this is a situation where you've got a couple that get together, they've got kids from previous relationships, they get together, they get married, they just do very simple mirror wills, leaving everything to each other on first death. First death passes over to the surviving spouse. The surviving spouse leaves all that money and all those assets then to their children and completely disinherits the other side. And that's why we're seeing more inheritance tax disputes, these days, or not inheritance tax, sorry, inheritance disputes these days, because people are going, hang on a minute, my dad said he was going to leave me this money, and suddenly it's gone down that side to a second, third spouse, marriage, and therefore it's gone down to their children, completely disinherited the other side. And that's a real problem. And we can protect that with the trusts, again, making sure all the beneficiaries can benefit from it. And it's all about, the efficient transfer of wealth across the generations. We would say it's very, very important, particularly now with the advent of the trust registration service of HMRC, to have professional trustees. We are a firm of professional trustees for our own trust book. And we do everything in terms of registering a trust, any tax returns that are required, liaising with the advisor, drafting any documentation, reversions to the settler if they're having money back, loan agreements out to the beneficiaries, appointments, including the use of things like capital gains tax, whole relief. We do all of that. So it eases the administration for the advisor and their support teams. And we're making sure we get the best client outcome we can get because we're aware of all of the allowances that we've got and what's available. And then just, what a typical way client looks like, for advisors out there who are looking at IHT planning. Most of our clients are 55 plus, most of them are in the 60s, although I have got a new case inquiry for someone who's only 25, but that's an absolute rarity, but there are some that that come out like that, but most of them are 55 plus. They've got children and grandchildren, which motivates them to want to do the IHT planning in the first place. They're pre or post retirement. They're often professionals or business owners. And then from an excess capital perspective, quite often they've recently inherited from the parents. So because people are living longer, we're now finding people are inheriting money in their 60s and sometimes in their 70s because the parents are living into the 90s and they're going, I don't need this. The last thing I need is more money in my estate. I'd rather do a complete generation skip and pass it down to my kids who might be in the 40s or 50s, or even going like, let's pass it all the way down to great grandchildren. Let's completely bypass the next 2 generations because we don't need it. They've sold the business, so suddenly they've gone for something which was business relief qualifying to something that now isn't. They've just got a massive sum of money, millions of pounds, and suddenly they're going, right, I've lost all that business relief. Now I've got a big IHT problem. I need to do something with this. They've often downsized, sold a second property or a buy-to-let portfolio, and have got a lot of cash that they've realised. You can obviously do something with the cash and start to gift it. High value ISA portfolios is not uncommon for us to see £1 million plus in an ISA portfolio for an IHT client because they've taken good advice along the way, or they've been very clever themselves and put 20 grand a year into their ISAs. And they've got a massive ISA portfolio, but of course it's all sitting inside the estate. So your £1 million ISA portfolio actually in the hands of the beneficiary is probably only worth 600,000 because you're going to lose 40% in IHT on it. Because if you've got £1 million in ISAs, I bet my bottom dollar that, most of them would have an IHT problem already, because all their other assets would take them above, the threshold. And then from an excess income perspective, final salary pension schemes has been our biggest area up to date. And it's tended to be retired medical professionals of one description or another. We've got very, very good final salary income, index linked, and they can't spend it. They've earned very well during their lifetime, and they have not carried any debt in retirement, and suddenly got, this massive income that's more than they need. And it's accumulating inside the estate, and we can do something about that and gift the money away using the gifts from normal expenditure rules. We've got people, of course, who've got investment income coming from dividends, etc. Earned income from salary is an obvious one, but sometimes overlooked in terms of people are getting a lot of income from salary, particularly professional sports people, for example. Dividend income I've just mentioned, rental income as well, buy-to-let property income, holiday lets, etc. All those things, all add into their income sources and could be utilised. And then to finish it all off, we looked at consumer duty and foreseeable harm. We've looked at a case study and a before and after trust planning. We've looked at how to settle multiple trusts to make sure advisors stay compliant within the consumer duty foreseeable harm rules. The optimum order of the trust settlements to mitigate entry, periodic and exit tax charges, actually. And then the 14-year rule and how to avoid falling foul of it. And that's us. That's what we do.
That is Ways. That is Ways, guys. Thank you so much for joining us. Just the last question. How much more confident do people feel now, determining the order in which the trust needs to be settled? I think I know where this is going to sway. I think it's been very clear and very insightful, isn't it? As always, every webinar comes with loads of questions, and most people requiring slides and recordings because there's just so much to take in. But if this isn't your bag, this isn't your bag. It doesn't need to be. You can't be a specialist at everything, and that's why we need to get other people involved, people that do this stuff day in, day out, and speak to proper specialists to support your clients.
Yeah, I'm really, happy with, obviously, with the people who are feeling very confident and somewhat confident, and those that are still not confident in settling multiple trusts. That's why we're here. That's why we're here to help and make sure that we can get them to a point where they are more confident to do it, and we can help structure it in the right order so that they do become confident.
Do you find yourself having meetings with the advisor's clients as well? Just if the advisors aren't feeling confident in articulating or really demonstrating and going through the nitty gritty, you guys
Mark and
get
I
involved?
do that regularly. Yeah, I've got 4 next week.
Have you?
Yeah, when I'm meeting clients with the advisor. Now, I can't give any advice. Where you're not authorised to give financial or investment advice, but we can talk about this, type of planning and how to structure it. The advisor then would give the advice as to the suitability for the client. Because the reason we're there anyway is they've got an IHT problem, otherwise they don't need us.
Yeah.
But yeah, Mark and I do both do a lot of those meetings with the client and the advisor, because we can take all the technicality out of it. We can, we've been doing it for so long that we can talk to the client and in a way that they can understand why we're doing these things. And then, of course, we can help the advisor to put a client report together to make sure that the suitability of the advice is correct, all compliant with consumer duty foreseeable harm. We've optimised the order of the trust planning, etc., 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 because we'll be able to identify and some of the things the advisor might not have identified if we weren't there, and we'll ask maybe some more pertinent questions with regards to gifting, what they've done previously, when they did it, how they did it, and then we can put together a rounded summary for the advisor to say, well, this is what we would suggest a good estate plan looks like. The one thing that, before we go, that does still stagger me is people who've got significant wealth haven't got wills in place. Does still happen. It's just like, really, they haven't got a will in place, and they haven't got lasting powers of attorney in place. And again, Mark and I would be saying, in that scenario where we come across that Even if you have got a will in place, if it's, hasn't been looked at for 10 years, it really ought to be looked at again to make
Mm.
sure it's still, what you wish to happen and still, relevant. But also, lasting powers of attorney are absolutely crucial, really are, and so many people haven't got them. And if you've got significant amount of wealth, it's absolutely imperative that they
Mm.
do have those in place. But I'd say they're imperative for most people, but certainly for those who are wealthy and got big IHT
Mm.
liabilities, be able to access the assets and be able to utilize those assets and have the attorneys in place is really important.
Is there a minimum amount or a minimum portfolio size that's needed to really utilize and benefit from this kind of sort of structure and setup?
Yes, if the gifts from income trust, we're normally looking at £30,000 a year plus of surplus income. And then for the loan trust and the gift trust, again, you're normally looking at £100,000 plus
Mm.
to go into those. Anything less than that, and frankly, that it wouldn't be worthwhile from the client's perspective because of the charges to actually run that type of trust. So we would have a minimum of 1% plus VAT as a charge going forward for the trust and for professional trustee services combined. So we've got a minimum on that of £1,200, for example, on a loan trust or a gift trust. So again, that naturally would lend itself to £100,000. Otherwise, the minimum would still apply, and you'd be paying more than the 1% plus VAT in real terms. Yeah, so you're looking at £100,000 plus for the gift trust or the loan trust, and £30,000 a year for the gifts from income trust. Because again, that starts with a lower minimum on that. So that again, still 1% plus for that, but a minimum of £300 on that trust, because that naturally just builds up over time. And there's not as much for us to do from a trusteeship perspective because you can't take any money out of that for the first 5 years as a settler. So that's a little less administrative intensive, hence why we could have a lower annual fee on that to start with. But yeah, they're the sort of figures you're looking at, really. Anything less than that, and I'd say, well, it might be wise just to give that money away directly to
Yeah,
children or grandchildren, at least get it outside the estate, even if it's not using a trust structure. Um, yeah.
amazing. Um, Thank you again,
You're
John.
very
I know
welcome.
we've overrun 10, 15 minutes. Thank you for everybody that's come along, listened in, and joined us today. You'll get an email from most definitely us at the club sharing the recording and the slides. Don't forget, if you need a CPD certificate, it's on the feedback form when you exit today's webinar. I believe John and the Way team will also drop you an email thanking you for joining us in today's session. If you need any support, if you've got any questions, if you want to just have a conversation with the guys at Way Trustees, there will be a part on the feedback form that will give you the opportunity to request some time with them, just to have a conversation, just to see what it's about and how they can support you and your advice and your clients. Really, it'd be really good.
Brilliant. And thank you, everybody, for joining us today. And thanks again, Lee, for hosting. Really, really appreciate it. Cheers, mate.
Anytime, anytime. I'll stop the recording and I'll see you all next week.